Lundin Gold missed Wall Street consensus estimates on both the top and bottom lines on an adjusted basis for Q2 to 2026.
Yeah, revenue came in at $477.69 million.
Right, which represents a 33.03 million, or about a 6.47% miss versus the 510.72 million consensus.
And adjusted earnings per share, I mean, that landed at 84 cents, missing the 93.7-cent estimate by roughly 10.4%.
But, and this is the kicker, despite these misses, management actually reaffirmed their full-year 2026 production guidance of 475,000 to 525,000 ounces.
Along with their all-in sustaining cost guidance of $1,110 to $1,170 per ounce.
Exactly. And following this release, the stock just gapped up in the pre-market. It closed higher by 6.5% on the TSX at 92 Canadian dollars and 3 cents.
Yeah, and on the U.S. OTC markets, it closed up 5.67% and $91.62.
Right, and that was trading on just massive volume of over 700,000 shares.
The divergence there between, the headline earnings miss and the immediate bullish market reaction is just striking.
It really is. I mean, you have this definitive double-digit miss on the bottom line, yet institutional investors just stepped in aggressively, bidding the equity significantly higher throughout the entire trading session.
Right.
So the mission for this deep dive is to figure out for you, the listener, exactly why a stock experiencing that kind of top and bottom line miss triggered a 6% rally and, honestly, a wave of analyst price target upgrades, too.
Yeah, like BMO Capital Markets, they immediately raised their target to 95 Canadian dollars.
Exactly. Watching this market reaction unfold, it kind of felt like watching a basketball player, completely whiff a layup, right?
Oh, absolutely.
But then they immediately grab their own rebound, step back behind the arc, and just drain a three-pointer. The headline box score just shows a missed shot, but the follow-through is what the crowd, and in this case, the market, actually cared about.
That basketball analogy really frames the situation perfectly. Because to understand the market's enthusiasm, we have to look past the superficial headline miss and examine the underlying operational reality here. Right. The driver behind the production miss, it was actually heavily telegraphed by management in previous quarters. They explicitly guided that Q2 would be the lowest production quarter of the entire year.
Yeah, management cited geotechnical mine sequencing and 9 days of planned processing plant maintenance as the primary culprits. But I think we really need to unpack what geotechnical mine sequencing actually means in practice,
Definitely.
Because to the average investor, that just sounds like generic corporate jargon for, we mined less gold.
It totally does sound like a convenient excuse, but it is a fundamental, mechanical reality of underground mining. You aren't just, turning a dial to produce more gold.
Right. It's not a faucet.
Exactly. A mine like Fruta del Norte operates using a system of stopes, which are essentially these massive underground caverns where the actual ore extraction takes place.
Okay.
And once a stope is mined out, you cannot simply move to the one right next to it immediately. You actually have to backfill the empty stope with this cement paste to stabilize the surrounding rock before you can blast the adjacent area.
Wow, okay.
Yeah, so geotechnical sequencing just refers to this precise, highly engineered schedule. During Q2, they were in a phase of the sequence that required them to mine lower-grade areas, while simultaneously preparing the infrastructure to access their higher-grade stopes for the back half of the year.
Right, so you combine that sequencing with the 9 days the processing plant was taken completely offline for maintenance, and the quarterly volume drop makes totally logical sense.
Exactly.
But even with that downtime, the underlying strength of the ore body is just difficult to ignore. I mean, the mill still processed over 500,000 tons of ore, and the average head grade was 8.3 grams per ton, with recoveries holding super steady at 89.1%.
Which is wild.
It is. To put that into perspective, for anyone not looking at mining stocks every single day, an 8.3 gram per ton head grade is exceptionally high for a gold mine operating at this commercial scale. Most bulk tonnage operations are thrilled to get 1 or 2 grams per ton.
They really are. And the plant throughput data is really where the institutional money likely found its conviction. I mean, officially, throughput averaged 5,496 tons per day for the quarter.
Right.
But if you look closely at the daily operating metrics, there is a super crucial detail. Once you net out that 9-day maintenance period, the actual operating days in the month of June ran closer to 6,000 tons per day.
Wow, okay.
Yeah, and analysts look really closely at that specific figure because it proves the plant's actual run rate capacity is significantly higher than the baseline average. It shows the mill can handle a massive scale up in volume when it is running uninterrupted.
Okay, but let me push back on that slightly. Are we giving management a bit too much of a pass for this planned maintenance? Because a miss is still a miss.
Fair point.
And their cash operating costs came in at $1,016 per ounce, and their all-in sustaining cost, or AISC, climbed to $1,176 per ounce. That represents sequential inflation quarter over quarter. So why didn't the market punish that margin squeeze?
Well, because the market looked directly at the math driving that AISC metric. The cost per ounce increased primarily because of the denominator effect.
Okay, break that down.
So AISC is calculated by dividing your total sustaining cost by the number of gold ounces sold. Because production and sales were temporarily lower due to that plant downtime and the stope sequencing we just discussed, you are essentially dividing your fixed costs by a smaller number of ounces.
Right. So the spike in the per ounce cost is really just a mathematical artifact of the lower production volume rather than an indication that they are suddenly, spending wildly to extract the gold.
Exactly. And furthermore, capital spending was heavily concentrated in Q2 for their 5th tailings dam raise.
Okay, and a tailings dam is what exactly?
It's the critical infrastructure needed to safely store the leftover crushed rock and liquid to tailing after the gold is chemically extracted. As a mine produces more material over its life, you have to continuously build the walls of that dam higher, using heavily engineered materials to ensure environmental safety. So it requires massive, lumpy capital expenditures.
So you combine that heavy planned Q2 capital outlay with a lower denominator of ounces sold, and your cost per ounce just naturally spikes.
Exactly.
But even with that temporary spike to 11,176 sublers per ounce, the financial profile remains incredibly robust. I mean, with gold prices where they are, Lundin is maintaining an elite AISC margin of 73%.
Yeah, that's massive.
When an operator retains 73 cents of margin on every single dollar of gold sold, the market understands that the cost increase is just a timing issue, not some structural degradation of the asset's underlying profitability.
Right. And while those operational timing issues totally explain the adjusted earnings miss, there's a fairly complex accounting bridge we need to cross to understand the full financial picture.
Okay, let's hear it.
So while the adjusted EPS missed estimates, the GAAP net income actually beat them. On Canadian markets, GAAP net income came in at 306.44 million Canadian dollars.
Wow.
Yeah, representing a 1.73% beat, which brought GAAP EPS to 91 cents US.
Wait, let me slow down for a second. The adjusted operating profit was roughly $201.9 million, yet the GAAP net income was significantly higher. Usually, adjustments strip out one-time charges to make earnings look better.
Right, usually.
But here, the unadjusted GAAP numbers are actually higher. Walk me through the actual math there, because that feels deeply counterintuitive.
It does. It requires digging into the footnotes regarding a transaction they closed in Q2 with Lundin Royalties. It was this really complex silver stream for equity transaction.
Oh, right. Lundin distributed just over 50.5 million shares of Lundin Royalties directly to its shareholders as a dividend in kind.
Yeah.
That represents an aggregate distributed value of roughly $747 million. Interestingly, though, Newmont ended up receiving a 13.3% stake in Lundin out of that distribution because of their existing ownership in Lundin.
True. But the accounting mechanics for distributing that equity are what actually created the earnings divergence. See, when Lundin Gold distributed those Lundin shares, accounting rules required them to recognize a one-time non-cash fair value loss of approximately $74.6 million on the income statement.
Okay, so they gave away an asset to shareholders, so they had to book a paper loss. I follow that part. But how does booking a $74 million loss result in a GAAP earnings beat?
Because that paper loss was immediately offset by a substantial non-cash fair value gain of $126.7 million related to their silver stream obligation.
Stop right there. Explain the mechanics of the silver stream revaluation. Like, how does giving away shares in a royalty company trigger a massive accounting gain on a completely separate silver obligation?
Okay, so a silver stream is essentially a financing mechanism. Years ago, Lundin took cash up front from a streaming company to help build the mine. And in exchange, Lundin promised to deliver a percentage of their future silver production at a heavily discounted fixed price. On Lundin's balance sheet, that obligation to deliver future silver is recorded as a massive liability.
Okay, that makes sense.
But the total value of that liability fluctuates based on two things: the current spot price of silver and any modifications to the life of mine production plan.
Oh, I see. So as part of this broader Lundin transaction, they restructured or remeasured that specific liability.
They remeasured it. Because the variables change, specifically the mechanics of the stream agreement tied to this new equity spinout, The present value of what Lundin technically owes dropped significantly. And when a liability decreases on your balance sheet, you actually have to run that difference through the income statement as a gain.
Wow. So taking the $74.6 million loss from the equity distribution and then offsetting it with the $126.7 million gain from the remeasured silver stream, that results in a net pre-tax impact of a positive $52.1 million. It feels a bit like refinancing your house and pulling out equity to give to your family. Like, on paper, your personal cash flow looks temporarily skewed by the bank fees. That's the $74 million accounting loss.
Right.
But your family is much richer from the equity distribution, and your future monthly obligations to the bank, which is the silver stream in this case, just got restructured and are now way cheaper on paper, triggering a gain.
That's a great way to look at it. The economic reality of the transaction is highly favorable for the balance sheet. It dramatically reduces their future liabilities, even if the quarterly income statement temporarily requires like a decoder ring to figure out.
Seriously. So the market essentially forgave the operational miss because of the 73% margins and that 6,000 ton per day June run rate. And they forgave the adjusted EPS miss because the economic reality of the Lundin transaction was a net positive.
Yeah.
But if we're looking for the core catalyst, the real reason institutional investors were aggressively buying, we really need to talk about the cash flow engine and the dividend mechanics.
Absolutely. Yeah. The bullish analysts view the Fruta del Norte asset as this premier self-funding operation. I mean, it generates sector-leading margins, capable of funding massive internal growth, while simultaneously returning just unprecedented amounts of capital to shareholders.
The dividend math here is staggering, and we really need to walk through it step by step for you guys. During the quarter, the company generated unadjusted free cash flow of $96.03 million.
Right.
However, in Q2, Lundin paid $221.37 million in annual statutory taxes and profit sharing to the Ecuadorian government.
And that annual payment happens entirely in the second quarter. If management based their dividends solely on that unadjusted Q2 free cash flow, the dividend would crater, right?
Oh, totally.
Then it would just skyrocket in Q3 and Q4 when those tax payments aren't due. So to smooth out those returns, management uses a specific formula to calculate a normalized free cash flow.
Okay, so they take that $221.37 million annual tax payment and prorate it across the 4 quarters. That comes out to $55.34 million per quarter. Then they add that $55 million back to the unadjusted free cash flow,
which brings the normalized free cash flow for Q2 to $189.50 million. And the critical piece of this formula, and really the reason income investors just love this stock, is that management pays out 100% of this normalized figure.
It's crazy they distribute 100% of it as a variable dividend. So this quarter, the variable portion was 78 cents per share, and that's layered on top of their fixed baseline dividend of 30 cents.
Exactly.
That resulted in a massive $1.08 per share Q2 dividend, pushing the annualized yield to approximately 7.0%. And on top of a 7% yield, management is also executing share buybacks under a normal course issuer bid.
Yeah, returning 100% of free cash flow signals supreme confidence from management regarding the health of their balance sheet. But, the market isn't just buying for today's yield, they're buying into the future scale of the asset. Management's commentary heavily emphasized moving beyond just a single mine and scaling into a massive district.
The exploration drill results they reported from FDN East are just phenomenal. I mean, they hit a record interval of 4.0 meters at 236.6 grams per ton gold.
Which is insane.
Yeah, I mentioned earlier that 8 grams per ton is considered high grade. Hitting 236 grams per ton over a 4-meter stretch is an astronomical concentration of gold. Additionally, they discovered 2 new copper-gold porphyry centers, bringing the total number of porphyry targets in the district to 7.
Right, but we need to draw a really sharp distinction here between the current mining operation and these new porphyry discoveries.
Okay.
Fruta del Norte is an epithermal vein system. It is relatively compact, incredibly high grade, and highly profitable to mine underground. Porphyry systems, on the other hand, are entirely different geological beasts.
How so?
They are massive, sprawling, lower-grade deposits that typically require bulk tonnage, open-pit mining, or, block caving.
Right, and here's where it gets really interesting for you as an investor. If porphyry systems require massive scale and entirely different infrastructure, they must be incredibly capital intensive to build.
Oh, absolutely.
So they are essentially draining their cash reserves to maintain this 100% payout ratio and a 7% yield today. But if they have to build out massive new porphyry centers tomorrow, that math suddenly hits a brick wall. What happens to the 7% yield when the heavy build cycle starts?
And tension is exactly why 11 analysts are currently sitting on the sidelines with hold ratings on the stock. Developing porphyry centers requires hundreds of millions, sometimes billions of dollars in upfront capex.
Yeah.
Bulls argued the current 73% margins from the underground mine can self-fund that capex without requiring debt. But bears question the sustainability of a 100% payout model during a transition of that magnitude.
Yeah, and the bearish arguments extend beyond just the future capital requirements, too. They are heavily rooted in geopolitical and single asset risk. Lundin Gold's entire operation is concentrated at a single site in Ecuador.
Right. That $221.37 million cash outflow we walked through, the annual statutory taxes and profit sharing, proves the asset is immensely profitable. However, it simultaneously highlights the company's severe sovereign exposure.
Yep.
The Ecuadorian government takes a massive, legally mandated cut of the cash flow.
Right. So what does this all mean? The market is looking at a debt-free balance sheet and cheering the dividend, but are they completely ignoring the fact that one regulatory pen stroke in Ecuador could wipe out that normalized cash flow calculation overnight? It's a single point of failure for the entire investment thesis.
It really is. And bears are also pointing to a nuance in the Q2 revenue miss that wasn't entirely driven by the planned plant maintenance. It actually had to do with provisional pricing hits on the gold they sold.
Oh, explain how provisional pricing works in this context. Because if the price of gold has been strong, why are they taking a hit on their realized price?
Well, when a mining company produces a concentrate rather than a pure gold bar, they ship that concentrate to a smelter. Because it takes weeks for the shipment to arrive and be processed, the miner receives a provisional payment based on the gold price the day the ship leaves the port.
Okay.
However, the final settlement price isn't locked in until the smelter actually processes the material a month or two later.
Oh, got it. So if the spot price of gold drops between the day the ship leaves the port and the day the smelter processes the concentrate, the miner takes a negative adjustment on revenue they thought they had already booked.
Exactly. And during Q2, declining gold prices during those exact transit windows triggered negative provisional adjustments. It reduced their average realized gold price by $166 per ounce, dragging it down from a gross price of $4,525 per ounce.
Oh.
Yeah, that mechanical adjustment contributed directly to the top-line revenue miss.
And looking ahead, bears also caution that financial volatility on the GAAP income statement is practically guaranteed. Because that massive silver stream obligation is revalued quarterly based on fluctuating spot silver prices, investors should expect continued wild swings in GAAP earnings from quarter to quarter.
For sure. But the market is currently weighing these risks against the immediate rewards. Those sector-leading 73% margins provide a substantial risk premium. Investors are willing to accept the single-asset geopolitical risk of Ecuador and the noisy accounting because they're being paid a 7% yield to wait.
Right.
And that's all supported by one of the highest-grade ore bodies on the planet. To synthesize the current state of play here, Lundin Gold is operating as a cash-printing, single-asset producer. The institutional money is evidently very happy to look past short-term, timing-related adjusted misses in production and revenue.
Yeah.
They are focusing instead on the elite margins, the proven 6,000-ton-per-day mill capacity, strong exploration upside, and that heavy dividend yield.
But there is a final strategic puzzle derived from the management commentary that you really need to mull over. Management noted they plan to combine the required mine and processing plant expansions into a single, massive investment decision slated for late 2026.
Which is huge.
It is. And this decision will arrive right alongside a maiden resource estimate for the Sandia porphyry in early 2027. So if Lundin Gold successfully transitions from a highly profitable single mine operator to a sprawling multi-asset district producer, will the required capex force them to abandon the very 100% free cash flow dividend model that is currently driving their premium valuation?
That's the billion-dollar question.
Exactly. The missed layup might have turned into a three-pointer today, but building out a porphyry district means playing a much longer, vastly more expensive game tomorrow. If you want to stay ahead of the curve and unpack these kinds of earnings complexities before the market reacts, make sure you follow the show for our daily, no-nonsense earnings coverage. See you next time.